Okay, it's good to see everyone back, or most people back in the room. Of course, there'll be some more time after today's conference to do a bit of networking and to enjoy some more refreshments. It's a pleasure to have the Reserve Bank of Australia with us again today. Of course, the RBA is an institution which works closely with the Australian Securitisation Forum. From memory, I think we had Guy DeBell here last year, and this year I'd like to call on our next keynote speaker. It's Chris Aylmer. He's the Head of Domestic Markets Department at the RBA, and he's here to tell us about the developments and prospects of secured issuance. And if we do have time, we'll also throw to you guys on the floor, get a microphone passed around for some questions for Chris. Thank you.
Thank you for giving me the opportunity to speak at this forum. Today, I would like to do two things. The first is just to take the opportunity to reflect on developments in secured issuance in recent years. And secondly, I would just like to speak a little about the Reserve Bank's reporting initiatives in this area, which were actually announced by Guy DeBell at the corresponding meeting a year ago. Now, it's been almost 2 years to the day since the first covered bond was issued by an Australian bank. It was not an easy time for new issuers. Financial markets, as you may recall, were fairly volatile, and the US Fed, the ECB and the Bank of England had all announced non-conventional policies towards the end of 2011. The covered bonds that were issued, AAA rated 5-year securities, were sold at spreads to CGS of more than 220 basis points. I'm sure the issuers will recall what the actual spread was. Ultimately, conditions improved, and over the 2 years since the passage of the enabling legislation, covered bonds have proven to be a useful source of funding for Australian banks, notwithstanding the fact that they have brought about some subordination of unsecured debt holders. About $57 billion has been raised, predominantly in offshore markets. This represents just over 1/4 of the bank's long-term debt issuance over this period, although the pattern of issuance has evolved with financial market conditions. In particular, covered bonds have proven useful as a wholesale funding source that is less sensitive to global risk events than traditional unsecured funding. This was evident in the bank's issuance of predominantly covered bonds in early 2012 as conditions in funding markets deteriorated because of sovereign debt concerns, particularly in Europe. In fact, around that time, the Reserve Bank noted that the delineation between secured and unsecured funding for the banking system was perhaps not as stark as market conditions implied at that time. As it turned out, conditions in global unsecured funding markets improved from mid-2012, and Australian banks returned to what might be considered more typical patterns of issuance, raising the majority of their wholesale funding via unsecured bonds. Importantly, covered bonds, as you will be aware, have enabled banks to diversify their investor base and reduce their funding risk. Australian banks' covered bonds have consistently been rated AAA, which has allowed the banks to attract new funding from investors with AAA mandates. This has probably also assisted those banks repurchasing their government guaranteed debt, as the banks were able to offer investors an alternative AAA asset to invest in. There's also some evidence of a broadening in banks' investor base along the geographical dimension, with regional central banks, for example, among the buyers of Australian covered bonds. European investors have also provided demand for these instruments, reflecting their familiarity with the asset class. This has contributed to banks issuing wholesale debt across a broader range of currencies in the past 2 years compared with their issuance patterns prior to the introduction of covered bonds. In particular, a larger share of banks' bond funding has been raised in euros, notwithstanding the ructions in European markets at times. The increase in the share of euro-denominated issuance has been entirely due to covered issuance. Moreover, Australian banks have issued covered bonds in Swiss francs, Norwegian krone, currencies that have been scarcely used for unsecured issuance. Covered bonds have also enabled banks to increase the tenor of their issue, which has helped to smooth the maturity profile of their outstanding debt. The banks have typically issued covered bonds at tenors of 5 to 10 years, compared with a norm of 3 to 5 years for their unsecured issuance. More strikingly, the banks have issued covered bonds at very long tenors, sometimes exceeding 15 years. With the Australian banks supplying around 10% of global covered bond issuance recently, compared with about 5% of financials' unsecured issuance, they have established themselves as covered bond issuers in the global markets. That high share of global covered bond issuance reflects both subdued issuance by European institutions and the desire of the Australian banks to establish themselves in the market. Perhaps more importantly, these bonds have traded at similar spreads to comparable issues by foreign banks, as you can see here in this graph. There is scope for further issuance, with each of the major banks having utilised roughly 1/3 of its legislative limit, based on current levels of over-collateralisation. It's likely, however, that banks will use their remaining capacity sparingly, particularly if conditions in global funding markets improve further. Banks have indicated a preference to keep some capacity for covered issuance in reserve to draw upon in the event of another bout of stress in global financial markets. I'd now like to turn to developments in securitisation. The improvement in funding market conditions since the middle of 2012 has also exerted its influence on the securitisation market more broadly. The past year has seen a steady run of deals with pricing at some of the tightest spreads since 2007. The decline in the cost of issuance has extended to non-bank lenders and smaller banks. In particular, a number of issuers have returned to the market after a hiatus of several years. And there has been a re-emergence of demand for non-prime RMBS, including deals with a significant number of low-doc loans. More broadly, investors seem to be increasingly comfortable with greater variation in pool characteristics. This is perhaps best illustrated by the greater variation in loan seasoning observed in the past couple of years. Some issuers have been able to place loans with investors that they had previously held on their balance sheets for an extended period, while others have sold pools of relatively recent loans. There has also been a greater variation in the structures employed by issuers during the past several years. Some issuers have reduced their use of LMI, which follows a move by the credit rating agencies to discount the credit enhancement that LMI brings to an RMBS. On the other hand, credit support has been increased to maintain AAA ratings. Recent years have seen the emergence of some preference for bullet structures to minimise prepayment and extension risk for investors. Offshore investors in particular have shown a preference for bullet features. This partly reflects the mandates of certain investors, such as US money market funds, to hold securities with finite maturities. Issuers have incorporated arrangements such as liquidity underwriting and rollover features to provide bullet-like structures to deals. Nonetheless, there are limits to the extent that these structures can be incorporated without significant over-collateralisation or liquidity underwriting costs. As such, bullet notes have typically accounted for a small portion of the funds raised in an RMBS. The securitisation market remains principally about passing through cash flows. Taken together, the increased variation in deal characteristics, alongside tighter pricing and a solid pace of issuance, point to an improvement in the underlying demand for Australian RMBS. Indeed, with the recovery in demand from private investors, the AOFM announced in April that it would not make any further investment in RMBS. For around 4.5 years, the AOFM acted as a cornerstone investor, purchasing AAA-rated tranches of small lenders' RMBS. In fact, the AOFM has actually sold a very small amount of RMBS in the past year. It currently still holds about 8 billion of these securities, with its peak holding of about 11 billion in late 2011. Although if you look in gross terms at purchases, they're actually closer to 15 billion, which has been very important support for the market through that period. Some of the increase in private demand has come from abroad, which may reflect the dearth of marketed RMBS in some overseas markets. As you will be aware, RMBS issuance in Europe has been slow to recover amid subdued demand for credit among European households. Moreover, much of the securitisations that have occurred have been posted as collateral